Hey guys, today I wanted to start doing a little bit of video blogging instead of always just doing my blogs online where you read them. I know people sometimes digest video a little bit better than articles when they read them. So I'm going to give that a try. Let me know what you think. Today I wanted to kind of put down my response to an article I read. This article was called if your credit score is under 700, make these 5 moves ASAP. This was from a website called The Penny Hoarder. I've looked at a lot of things on The Penny Hoarder before. It's a really good website. They have a lot of good information on saving money and just financial stuff in general. But this article really piqued my interest because our country is really obsessed with credit scores, like insanely obsessed with credit scores. The article even says, and I quote, "You've got some algorithm spitting out some 3-digit number that's basically controlling your entire life," end quote. And that is true for a lot of people in the United States. That's how a lot of people feel, unfortunately. So as I was reading this article, reading through the 5 moves they suggest, I had some reactions, and I thought I would just put these down. The first move they suggest is to ask your creditors to remove negative items from your report. I've heard of this working before, although it still does confuse me a little bit, and here's why. If a negative item on your report is actually true, meaning let's say it says you made a late payment, and you did actually make the late payment, what incentive is there for them to remove it? Why should they? It's actually true and is going on a report, your credit report, which is a report of how well you pay back your debts. If you are making late payments, that should be on there. So I don't really understand why your creditors would have an incentive to really take that off, unless it was false. But if it was false, you should be disputing it anyway. And that's something that you should be doing regularly when you review your credit reports. If you find any false information, you should be disputing it. So that first point I was a little kind of iffy on, mainly because I don't really know what reason creditors would have to remove true information like that from your credit report. Although I have heard of it happening, so who knows. The second move they suggest is to pay for a service that'll help you improve your credit report / credit score. This one I have a big problem with. And the reason is most of the companies, or at least a lot of the companies that I've come across, what they're offering in their service is not much more than just a scam. Some of them are outright scams. Some of them are basically just scams. Even if they're legitimate, all they're really doing is going through your credit report and looking for errors or things like that, which brings us back to what we talked about in the first point. You should be disputing the errors on your credit report. You can get your free credit report from, one free credit report from each of the 3 major credit reporting bureaus free every year. So at least once a year, you should be looking at those. And if there are any errors on there, you need to dispute those. That's how things like identity theft happen and things like that. So paying for someone to do that for you, to me, that doesn't make any sense. That's something that you should be doing on your own. And kind of to the end of that, again, this puts you back in the control of your lenders, which I'll dive into a little bit more later. The third move they suggest is to take out a lower interest loan to pay off higher interest debt. Usually, when we talk about higher interest debt, we're usually referring to credit cards. Although sometimes people with low credit scores will get really high interest rate car loans as well. But generally, we're referring to credit cards. So this is a good strategy. But there's one really big condition to this strategy if it's going to be successful. You have to stop spending on the credit cards. If you take the money from the credit card and put it onto another loan, which opens up that credit card balance, and you just continue spending on the credit card, you've made the situation worse for yourself. Because now you have all that money sitting there over on the loan, and you're still racking up money on your credit card. So this tactic only works if you stop spending money on your credit card. In which case, transferring the balance to a lower interest rate and then attacking that will help you. And that will help you pay down your debt. You'll be saving money on interest, so that's a good thing. But I want to be very clear about this. The key to that working is not the interest rate. It's not that you went from an 18% interest rate to a 7% interest rate. The key was you and your attitude, the fact that you changed your behaviors and you decided to start attacking the debt. That's what made the difference. The interest rate just helped accelerate the process. Okay, so this is a good tactic with the, condition, the asterisk. You have to change your behaviors. You've got to stop spending on those credit cards, or you're just going to dig a deeper hole for yourself. The fourth move they suggested was to add utility payments to your credit report. This does seem to work. From what I can find, it is something that's offered even through some of the credit reporting bureaus. What it does is it adds some positive feedback, some positive items to your credit report, assuming you pay your utilities on time, of course. But that can help raise your credit score up, which is that's not a bad thing. So this tactic does seem to work. Now, I do want to say, generally speaking, it's not going to be a massive difference. The biggest difference this is going to make is when you don't have very much credit to get some good items on your credit report. If you don't have any negative items on there, that's going to help your score. If you have a bunch of negative items on your credit report, getting a few positive items on there might make a shift in the right direction, but it's not going to make a huge difference. And like the second point that we talked about, this is also going into that same mentality, which I have a big problem with, which I'm going to talk about at kind of the end of this. But this mentality of do whatever you can to keep your credit score up idea. This is just kind of playing into that, which is the reason that I don't necessarily like it. But I want to be clear. The tactic itself is fine. It's perfectly sound. There's nothing wrong with it. It's the mentality behind the whole thing, including this entire article, really, that I have a problem with. So anyway, we'll move on. Point 5, the last move they suggest you make is to find better insurance rates. Save some money on your insurance every month so that you can put that money towards debt. And when I read this initially, I wanted to stand up and cheer. I was like, yes, this is it. Because this is the only of these 5 moves that they have suggested you make, which in my opinion gets to what your goal should be. If you want to have a higher credit score, you should pay down your debts. Pay off your debts. But even that is not really the right goal, because your credit score should not be your goal, which is one thing I'm wanting to get to. But on the insurance side, yes, absolutely. This is an awesome move. Whether you are trying to pay off your debts or just in general, even if you're debt-free, check your insurance rates frequently. Once a year, get a quote and see if you can save a little bit of money, because that's money you can put towards your financial goals, whatever they might be. Now, that's the 5 moves they suggest they make. But I have an overall reaction to this entire article, which I think, in my opinion, is important, which is why I want to share it with you guys. Now, not everybody's going to agree with me on this. The main theme of this whole article and this idea that permeates our society here in the United States is one of what I call FICO worship. Meaning, do whatever you can to keep your credit score up, because your credit score is your life. And unfortunately, it's just not true. It does not have to be that way. We make it that way, but it doesn't have to be that way. We have driven this to a point where we equate someone's financial fitness, how good they are with money, with their credit score. And this is absolutely bonkers, because if you take examples of everyday millionaires, these are people who have a net worth of $1 million or more, meaning what they own minus what they owe totals $1 million or more, okay? These people may not have any credit score at all. If they have not been interacting with debt, they will not even have a credit score. Yet they have $1 million+ in assets to their name. Now, how is that? They're looking at their credit score would say that they don't know what they're doing with their finances, but they have $1 million, okay? This comes from the way that credit scores work. The whole thing. It's entirely a measure of your interaction with debt. It's all it is. Okay? Generally speaking, it's a measure of how responsible you are with your debt. But in order to have a credit score, you have to interact with debt. You have to borrow money, and to have a good credit score, you also have to then pay it back. This is from Experian's own website, and talking about the FICO score. 30% of it is based on how much you owe. So the amount of debt that you owe. 35% of it is based on your payment history. So if you total those two up, that's 65% of your score is based on what you owe and how well you've paid it back. Okay? 10% is based on new credit. So they weight some of that to newer credit. Meaning if all of your credit is years old, it actually hurts your score. 15% is based on your credit history, and another 10% is based on the mix of credit that you have. So your score is going to be higher if you have several different types of credit, not all of your debt tied up in one. Okay? But if the FICO score were a measure of how fit you were financially, how good you were with money, there's at least one massive thing missing from this list. Your assets. What you actually own. That doesn't show up anywhere on this. None of those things look at how much you own. That's how someone who's worth $1 million or more can have no credit score, simply because they have not interacted with debt. The irony of the whole situation is that the fact that they don't have a credit score, the fact they don't interact with debt, may be part of what has led them to become millionaires, because they're keeping their money. Having us chasing credit scores puts money in the bank's pocket. You borrow money and then you pay it back. That makes them money. You tie up your income constantly paying back stuff you bought in the past. But millionaires, everyday millionaires, lots of them, they keep their income to themselves and they invest it. So one of these methods puts money into the bank's pocket, and one of them puts money into your pocket. Which one do you want to do? Right? That's kind of the idea. So this idea of FICO worship, or doing everything you can to make sure you maintain that good credit score, it's not a long-term winning strategy financially. Please just remember, we've got to get out of this mindset that your FICO score, your credit score, is the definition of how good you are with money. It's not, because it misses a huge portion of your financial situation.